Currency prices never stand still. If you have ever stared at a Forex chart for a few minutes, you already know that. Rates shift constantly, sometimes by small amounts, sometimes by sharp swings that happen in seconds. The question is, why? The answer comes down to a handful of forces that every trader needs to understand. Once you can name them, price movements stop looking random. The single biggest driver in the Forex market is interest rates. Central banks, like the US Federal Reserve, the European Central Bank, and the Bank of England, set benchmark rates for their economies. When a country raises rates, investors can earn a better return by holding that country's currency. Demand rises, and so does the currency's value. When rates are cut, the opposite tends to happen. Demand falls, and the currency weakens. What makes this even more important is that markets do not wait for rate decisions to happen. Traders are constantly pricing in what they expect central banks to do next. This is why you will hear the phrase, rate expectations, so often. A single sentence from a central bank governor, even a vague one, can move a currency pair immediately. Marking central bank meetings on your economic calendar before the week starts is a habit worth building early. Economic data works the same way. Each week, governments release reports on inflation, employment, GDP growth, and more. Strong numbers generally support a stronger currency. Weak numbers tend to drag it lower. The U.S. non-farm payrolls report, released on the first Friday of each month, is one of the most watched. A result that comes in significantly above or below expectations can send the dollar sharply in one direction within seconds. The market is reacting not just to the data, but to the gap between the data and what was expected. Political events add another layer. Elections, trade disputes, and geopolitical tensions all create uncertainty. Markets tend to move away from uncertainty. When risk rises around a particular country, its currency often suffers. During those periods, traders typically rotate into safe haven currencies, the US dollar, the Japanese yen, and the Swiss franc, because they are backed by stable, reliable economies. And then there is market sentiment. Not every move is tied to a news event. Sometimes it is simply the collective mood of traders, optimistic or cautious, shifting at scale. When confidence is high, money flows toward higher-yielding currencies. When fear rises, it flows back to safety. These broad shifts affect multiple currency pairs at once. Underneath all of this is basic supply and demand. Every force discussed here ultimately works by changing how many people want to hold a given currency. Pick one upcoming economic release this week. Before it comes out, write down what the market expects. Then watch how the relevant currency pair reacts. That single habit will teach you more than hours of reading.